Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Zav Witdouck, Engineering Director at Talos, CK Zheng, founder of ZX Squared Capital, and Stephen Richardson, Chief Strategy Officer and Head of Banking at Fireblocks. We're here to discuss digital asset diversification strategies and understanding risk within the space. It's great to have all of you with us. Welcome to Trade Talks. Before we get to the conversations, if you could just kick us off, brief overview of where Talos is within the digital asset ecosystem.
Yeah, so Talos is a global technology company, and we focus on developing and licensing an institutional-grade digital asset investment and trading platform that encompasses all elements of the investment and trade lifecycle. So that includes portfolio construction, rebalancing, trade execution, including smart order routing across many, many different liquidity providers, both exchanges and OTC dealers. We provide a lot of middle office risk management tools to manage and control risk in portfolios. We facilitate settlement, and we also just acquired Coinmetrics a couple of weeks ago, which was announced, and that basically also fills out our data offering as well.
Yeah, and CK, tell us about ZX Squared Capital.
Sure. ZX Squared Capital is a high alpha, low risk, large cap hedge fund. We actually use an option strategy to reduce the volatility of crypto by 50%. So Bitcoin realized volatility usually around 60%. Our volatility is about 30%. But we outperform Bitcoin. So in last 4 years, our performance in aggregate about 380% in total versus Bitcoin about 260%. We only focus on large cap. Bitcoin, Ethereum, Solana is a portfolio. So we are very risk averse, but we think this is a great opportunity in this industry that in terms of asset class allocation to this, you get much better risk and reward in this area.
Yeah, you certainly do. And tell us about Fireblocks, no stranger to the show.
Yeah, so Fireblocks is a digital asset technology firm. We're really focused on providing the critical infrastructure for institutions to be able to engage in digital assets. So think about that as wallet security, tokenization, payments infrastructure. But really the core technology needs that institutions from payments company through crypto native institutions find necessary to engage and build digital asset businesses.
Yeah, and it's interesting because you think about where we are now with the current state of institutional adoption, there certainly has been an acceleration here.
Absolutely. I think over the last year, especially as you think about broader regulation that's coming in place globally, we've seen a big push by institutions to think about the type of businesses that they should launch leveraging blockchain technology. And so that's become a more critical conversation over the last few months.
Yeah, it certainly has been. In CK, certainly, the Genius Act and seeing frameworks being pushed through has been a key catalyst to this.
To me, the Genius Act actually is the first major one globally. So I think people still have not really found the impact of this act. I feel today actually I'm much more bullish about the crypto than like when I started 4 years ago, because Genius Act actually bridged Wall Street into crypto. And the stablecoin is really a small, tiny space in crypto. If you think about it, it's about 280 billion, probably going to grow 10x very, very quickly. And the Wall Street, the major firms have to come into this area, whether it's Goldman Sachs or Morgan Stanley or JP Morgan or Bank of America. So this is going to be a huge amount of area, but this is just an example. Tokenization is going to come in as well. I think the SEC's project, crypto project, right? It's going to be huge amount of discussion how to get this thing become really a Wall Street machine in financial industry, how to use tokenization, make it cheaper, faster, and easier.
Yeah, and when you think about it, Zav, I think the fact that it's broadening out and there is some true diversification within digital assets now is another sign to show that it has matured and that the integration is taking place as we speak.
Yeah, there's no doubt. I mean, I think when you look at the success of the ETF launches, the Bitcoin and Ethereum ETF launches, I think a lot of investment managers have taken note. There's clearly significant demand for digital asset exposure. And so obviously the revenue in that space has already been captured, so a lot of investment managers now are looking as to what is next, right? And I think being able to offer more diversified exposure to crypto is kind of the next logical step in the process. And that might be using like smart beta type index allocations or active strategies like CK's firm does. But we've done a lot of analysis ourselves where if you just take sort of a top 10 asset composition and run sort of like these Monte Carlo like simulations, you can very clearly see the diversification benefits of holding sort of a composite set of securities as opposed to just holding Bitcoin or Ethereum from a Sharpe ratio, sort of information ratio type perspective.
So it sounds like you can adapt some traditional finance portfolio techniques to digital assets at this point.
Oh, absolutely, and that's exactly what we do at Talos, right? I mean, clearly, digital assets are quite different in terms of their return distributions. They have extremely fat tails because it's a much more volatile asset than you see in traditional finance. And also one of the major challenges is the volatility of volatility, right? So crypto vol is not constant. It changes anywhere between 40 to 80 to 100%. And so that, volatility of volatility is a real challenge. But having said that, you can take a lot of the quantitative techniques that have been pioneered in finance over the last 30, 40 years, adapt them and apply them to crypto, and they do work very well.
Yeah, and that's what you're doing at your fund.
To me, I think it's first people have to allocate to crypto, because when I talk to a lot of institutional investors, they haven't got ready to get into crypto yet. Right. And I was very happy to hear last month, Harvard, put 115 million into BlackRock ETF, IBIT. That's one step. But there's a lot of other institutional investors right now thinking it's never too late. Sometimes people think I'm late in this game, but I think today is still very early in the crypto adoption process, because the majority of the large endowment institutional investors are not in yet. Then you think about the 401k, right? The executive order of the president says, let's think about how to make a 401k investment. That's another huge $8 trillion market. If you have 1% of allocation in crypto, that will be bigger than, MicroStrategy's owning in the Bitcoin.
Yeah, I mean, if you look at the relative size of markets, I mean, if you just take publicly listed equities and public bonds, you're looking at sort of a market cap of around 250 trillion. Total crypto market cap is at like 4 trillion, so it's it's a rounding error in that respect. The other thing to note is that when you look at professionally managed assets, if you take global equities as an example, so say 130 trillion in global publicly listed equities, about half of that is professionally managed by institutional investment managers. In crypto, it's a small fraction. It's probably under 5% of the crypto 4 trillion market cap that is professionally managed. So the scope for growth is enormous. Especially
with investors demanding it. They want some alternative investment exposure, and you can certainly say that falls under the category. I do think we should address, though, the unique risks, though, within digital assets.
So I think from that perspective, right, there is this allocation basis, but really there's the infrastructure that's required to be able to really engage, right? And as you think about traditional financial institutions that typically provide that access, given where the regulation was over the last few years, that buildup of the type of infrastructure at that type of scale is still being developed, right? And so that's where providers like ourselves come in to help them develop the type of infrastructure, both from a wallet and security perspective, but also from an ecosystem accessibility perspective, right? So as you think about what is necessary there from a technology basis, the ability for banks and for asset managers to safely engage with digital assets and to enter into these open markets, and then to create structured products that then provide accessibility for investors becomes a critical part of this.
And I find it highly encouraging that risk management and thinking about the security aspects of this asset class is critical.
Yeah,
and those conversations are starting to lead at this point.
Absolutely.
But on this point, actually, not only just in terms of infrastructure, but also, I don't know if you're aware, there's a big amount of options market. So Bitcoin option, Ethereum option right now is on fire. The trading volume of a Bitcoin option, when I started 4 years ago, it's about $1 billion kind of volume transaction. Now it's like 120 billion monthly transaction volume. So usually when you have an option market started to develop, you can see the whole asset class become more mature.
Right.
And that's one of the reasons, actually, you can see the Coinbase just bought the Deribit, which is the biggest, option exchange. So I think this is actually the beginning of making this asset class much bigger, much more institutionalized in that asset class.
Yeah, I mean, the products are infinite, Zav, when you think about it like that, because of the derivatives that are being built off.
Totally, and I think I think the derivative market is also critical in terms of and you mentioned it earlier, CK, around building volatility managed strategies. Historically in TradFi, like vol targeting is a very popular mechanism where either you can do that, you can kind of target a specific volatility in your portfolio, either by deleveraging it, or you can overlay it with derivatives like options or futures to essentially control that volatility. And that's really critical, especially in crypto where the volatility is so high, because allocators make decisions. When allocators decide to allocate to a fund, they think in terms of a risk budget. They don't think in terms of a dollar budget. And so if your volatility is really high, that makes it very, very difficult for allocators to make allocation decisions to crypto. And it'll also suppress those allocations in dollar amounts. So if investment managers can offer institutional investors or allocators a volatility constant portfolio, that makes the allocation decision that much more easy and was likely to boost those allocations too.
But the product nowadays, actually, for many people want to allocate crypto, you can go to spot, Bitcoin or Ethereum. You can go ETF. You can go to stock market, the crypto companies or the crypto treasury companies. I think right now, actually, if you look at strategy, I mean, end of last year, they trade a huge amount premium in terms of their stock market versus their holding. It was 3x, more than 3x premium. Today, it trades about 50% premium. The new one, which is Bitcoin in terms of Ethereum, today trades about 40% premium. Now, I think that's another thing to look at. To me, it's a key indicator whether the market is very bullish in this asset or very bearish in this market. For people familiar with the last cycle, the biggest one was Grayscale, Bitcoin Trust, the GBTC. In the top of 2021, when Bitcoin price shot 68,000 at that time, the premium was 40%. So the holding versus the value of this trust. When FTX blew up and the crypto winter came, it traded a discount of 50%. So that's why it's so interesting nowadays. You have to look at not only spot, you look at ETF, you also look at companies, crypto companies, and how this trade dynamic change.
Yeah. I think that's what we're trying to understand too. Just when you're trying to value these companies, are you a bank because you have a treasury holding, or are you a technology company? So I think we're trying to figure out what are the proper ways to value it, and I just think in general that the environment is learning how these mechanisms work as well.
Yeah, I think across the board it's an exposure basis, right? And so I think you can look at it in terms of, like you mentioned, spot type product, derivative type products, and then accessibility to players within the broader ecosystem. I think you can also look at the accessibility of more of these type of products on chain, right? So if you look within the crypto native ecosystem today, tokenized money market funds are acting as collateral to enable 24/7 trading. They're acting as a basis of enabling more diversified trading strategies across the board. And I think as you're starting to see asset managers and other structured products come into the space, and as they start to evolve to be more digitally native, I think as you think about a market that operates 24/7, 365, the development of different strategies against those tokenized products, I think is something to watch over a longer period of time.
Yeah, and so you noted before, Zav, being able to understand liquidity, counterparty, operational risk. This is what TradFi is used to working with, and those rules aren't going to go away just because digital assets are on the scene.
Totally. No, I mean, I think a lot of the same frameworks are going to apply here. And so, I mean, certainly, if you take, for example, and this is a challenge that a lot of investment managers face around liquidity, right? So, there's obviously plenty of liquidity in Bitcoin and Ethereum. As you want to launch more diversified products, and you go into altcoins, like top 10, altcoins, the liquidity gets significantly thinner, right? And so that inevitably makes, a strategy very capacity constrained, right? Because if you think about the Bitcoin, IBIT, I think it's is it 80 billion in AUM at the moment? If you want to take an $80 billion portfolio and run sort of a top 10, allocation, or top 10 coin allocation on that, you very quickly become liquidity constrained where, your 10th coin, you simply don't have enough liquidity to run that book, right? So, but anyway, I mean, certainly, getting to a situation where you have high concentration, where you have a position that is like 10 days of average daily volume, that's clearly a risk situation that investors can't tolerate, right? So, but a lot of the frameworks essentially will still apply.
Yeah, and I also think protocol risk and custody risk has to be addressed.
Absolutely. I think in terms of custody risk, right, you're dealing with an asset that has no recourse, right? And so as you think about the frameworks from a regulatory perspective, the idea that you could be engaging with an asset that a nation state could then attempt to hack and diversify or take away those assets is significant risk at a holistic level. And so security is becoming a much bigger and critical part of the conversation around engaging with digital assets. And then as you think about assessing protocol risk, that becomes significant, right? Because these assets are sitting across global exchanges, they're sitting in decentralized exchanges, and the accessibility to that and the security around that, it becomes critical. So as you mentioned, liquidity becomes very fragmented and thin in the altcoins. And if you have significant breaches happening at the decentralized finance level, that could really impact liquidity for institutional traders as a whole.
And that's why I think that framework is critical for operators to understand, because you don't want everything moving offshore if you don't know what your operating environment
Absolutely.
is like. Because the whole point is to get this onshore.
I would agree, right? And so I think it'll be a question to ZK's point around the centralization around digital assets. I think there's a big conversation happening. Is it still an open ecosystem, or does it start to move towards more of a walled garden ecosystem where the larger players, the banks, the larger venues are really dominating that space? To provide that kind of security that's required for institutional investors to step in, I think that's a big question that's to be solved.
I think that's an interesting conversation because that's almost antithetic to the ethos of.
Correct. So my view is it's going to be after this, because essentially if you deal with the financial industry, you have to be regulated no matter what, right? So if you're regulated, then in many cases you have to be centralized. And that's why I think the Wall Street and the crypto is going to go together in some ways. If you're using the Genius Act is a doorway, I think the crypto project is coming laid out further in terms of how to get into the crypto and how make Wall Street and crypto actually combined. And in the future, I think it's going to be very interesting whether the crypto exchange or the traditional finance stocks exchange and how they coexist will be very interesting.
I think you're seeing that today if you look at stablecoins, right? So you're seeing banks announce the ability to directly mint into a stablecoin, for example. You're seeing them start to explore custody of stablecoins. So that's that first necessary step for engaging in these digital markets, but that's a combination of digitally native players that are offering a product with institutional players that are seeing the value of that product and how to provide that accessibility to their customers, right? I think overall you'll start to see that kind of trend line in the space.
I think stablecoins are a good place to start,
right,
relative to some of the other products that are
out
there.
The thing is, it's now we talk about the U.S. I think the U.S. lead this whole kind of innovation. But don't forget, there's a huge amount of people outside of the U.S. U.S. is only 5% population in the world. So you're potentially going to see Euro stablecoin, Chinese yen stablecoin, or Japanese yen stablecoin. There's all kind of things potentially going to impact other countries.
It could, but with stablecoin usage here, it also allows folks in other countries who don't have access to traditional banking or trading to get into the U.S. markets, whether you're thinking about treasuries, traditional stocks, if you will. So there's a benefit there, and I think we're starting to recognize that it's not just about the value and the hedging and the trading of it, but that this infrastructure is how capital markets are going to continue to evolve, and that's just going to bring more money into the U.S. ecosystem.
As long as U.S. leads this innovation.
Because you need it for scale,
Correct.
100%. All right, guys, we'll leave it at that. Thank you for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.